Hey, welcome once more to the No One Warned You podcast, the podcast where we have no fluff conversations about the things you should know when you're starting a business or growing your business. I am Henry, your host, and I've been an entrepreneur for 17 years now. Learned some things down the road and with some bumps, and those are the things I wish I could share with you and with the specialists that I bring here, business people, consultants, advisors, to give you great information on how to manage and grow your business. And today I have with me James from Second Strategy. And James, tell us who who are you and what is it that you do in your company?
Yeah, glad to be here, Henry. My name is James Agris. I run a boutique consultancy called Second Street Strategy. It's a 6-year-old firm, and we are focused on commercial due diligence and growth strategy for middle market private equity firms and their portfolio companies. This is a strategic consulting type of work that I've been doing for almost 20 years at this point in various iterations. I have a background McKinsey and Houlihan Lokey. And like I said, I started Second Street Strategy about 6 years ago.
Come on in. When you talk about mid-size market companies, what kind of companies are those?
Yeah. So, I primarily work with middle market private equity and their investments. So you think about companies that are between maybe $1 million in EBITDA to $30 million of EBITDA. And this is what I kind of typically analyze. I work with their private equity sponsors or rather potential sponsors. My work typically involves analyzing the company's strategy in the context of the market in which they operate. This is done during the diligence phase of an acquisition. So a private equity firm is looking to acquire, a company. They would hire me in order to analyze the market and its growth dynamics, understand how customers make purchasing decisions for that product or service, and understand what the competitive landscape looks like and how the target company differentiates from its competitors, and then kind of put it all together and provide a perspective on what that means for company growth post acquisition.
That's that's pretty cool. It looks like a lot, but for those watching here, we're gonna break it down. I'm quite sure James is gonna make you understand what it means, and most especially what it may impact in you and your business. And so, in today's episode, and this is a series of 3 episodes. This is the first episode. We're gonna talk about uh, they decide what you're worth in 1 minute without you. So basically, we're going to talk about things that may impact your valuation and how the market is perceiving your company. So, James, companies hiring you, what is it that, or where is it that you see their greatest shortcomings?
Well, again, companies don't necessarily hire me, Henry, right? A private equity firm that's looking to make an investment into a company is hiring me to analyze
Hmm.
that company, right? So this
Beautiful.
is this is what my work is, right? It's market analysis on a potential target for private equity acquisition. So it's not necessarily I'm looking for shortcomings, right? I'm trying to understand the company, um, like I said, the company's strategy in the context of the market in which it operates, and what that means for the potential acquisition. So that could mean, there's a lot of red flags or yellow flags that could, reduce the valuation of a company or potentially reduce the interest of the private equity sponsor to acquire this company. Or it could mean that the company is doing well and there's a lot of growth opportunities available for it post acquisition. And I am working then with the sponsor to help them understand what's the best way to capture that based on a kind of short assessment that I conduct prior to the acquisition.
Okay, so when you're doing those analysis, what are the green lights or what are the things you're looking for that mean that the company is would be a good acquisition or investment?
Well, so by the time it kind of gets to me, right, the private equity firm is already is usually under letter of intent, right? So they already agreed to acquire a company at a certain kind of price. pending due diligence, right? So the private equity firm, once this is signed, they typically an exclusivity period. It could be 60 days, it could be 120 days, under which they conduct due diligence, right? So they kind of open up the hood for a company and analyze all sorts of things, right? That I don't necessarily work, right? They look at the financials of the company and make sure that the books are kind of, in order, and all the revenue recognized according to, the appropriate rules, and all the chargebacks for the owner are, are taken out. They do legal diligence to ensure that the contracts that the company is under are, don't put the sponsor at any kind of risk. They do an IT diligence, right, evaluating the systems. But what they're looking to do with me, like I said, is understand the strategy of the company based on the market in which it operates, right? So, what are they looking for? Well, they want to understand that the market that the company is operating in is either large, right, meaning that there's a lot of white space for the company to continue growing, or the market is growing really fast, and understand the drivers of that growth, and understand if those drivers are at risk, right? So, a typical question I often get asked is, okay, what happens with this industry in a recessionary environment, right? If
Oh,
if we're growing fast, right, but then a recession hits, what happens, right? Particularly in the maybe this is a hotter topic, maybe 10 years ago, right? People were afraid of another kind of great recession. Um, and so that topic came up quite a bit, but it still does, right? Another question that the companies want to understand is, okay, is there a competitive differentiation that exists for this company, right? Do they have a moat, a defensible moat that they can present to its customers that prevent competitors from essentially gaining share, right? They want to understand customer decision making. How do customers find this particular company and services or products that it provides? How do they make their purchasing decisions to select this particular company as opposed to its competitors? And then, what causes churn? So, those could be both kind of green flags and red flags, right? If I find that the market is small and shrinking, the moats are indefensible, don't exist, and the customers view this particular product or service as a commodity, right? Those are all red flags, right? And if I find the opposite, then it becomes a green flag. But usually it's kind of combination of the two, right? So the market might be large, but the service is, not necessarily super differentiated, right? So then the question becomes, okay, post acquisition, how do you navigate this environment, and what do you need to do in order to remediate the issues that might be found?
okay, so if I'm getting it right, then it's likely that you will find some red flags, but if you find those, then it's a matter of understanding how to mitigate those. Is that right?
Yeah, I mean, most of the time, unless it's something serious, right? The private equity firm wants to make the deal, right? There's a reason they went through, identifying this target and going through the process and going through the LOI. A lot of, let's say, deal stopping red flags don't necessarily happen on commercial due diligence, which is what I do, but it's a legal due diligence. They find that some sort of a contract is, uh, creates certain risk, or the financials are, messed up in some way that, the EBITDA is not, $10 million, actually $7 million, and have to reprice the deal. So that, I mean, that happens quite a bit. But the type of flags that I find, right, red flags that I find often have to do with, okay, this is not a truly defensible, let's say, moat, right? So then the question becomes, okay, can we, if we lower the valuation here for this company, will the owner still, the current owner still take the current offer, right? If we reprice the deal, and if not, do we still want to make it at an original price and figure out how to remediate the issues, right? So it kind of becomes a back and forth, right? The work that I do is often an input into the decision making that the private equity sponsor, involves themselves in.
James, and I'm curious to know if in your position you take more kind of a neutral position, or is it more you're defending your contractor's interests more? How do you
Yeah.
how do you do
Okay.
your position there?
No, I mean, it's a great question. I mean, it's a great question, Henry. Like, I mean, what I like about what I do is the fact that I do get to take a neutral position, and I can very often bluntly provide feedback on the company that's, that the sponsor may or may not want to hear, right? In my previous roles working at larger consulting firms, I can frankly say that was not the case. And I've definitely had episodes where, I'll talk to a VP at a private equity firm, and we would present to them findings that, quite frankly, detrimental to the deal. And the VP would say, that's all great, but can we take these 3 pages out of the report that I'm showing to my investment committee or to my
Ooh.
lenders? Because I don't necessarily, we still want to make the deal and we deal with this post acquisition, right? Uh, I hated doing that because, I feel like this is a true due diligence kind of activity, what I do, right? And identifying these issues is kind of critical um, to the success of the acquisition. Going independent and working potentially with smaller sponsors, um, they do want to understand the potential issues with the company, right? They do hire me in order to provide kind of this independent perspective. So I really enjoy providing that.
So you have a much easier position per se right now as an independent rather than working for other companies that do that.
In this one regard, not necessarily in others.
I bet. Uh, you mentioned something, James, and I'm curious to know. So the the seller or the company that would receive some kind of investment, how usual or common is it that they think their business uh, has a higher value than it actually does?
um, Well, I mean, I don't necessarily get involved in valuation or putting a dollar amount on the business, right? It's always a negotiation, right? Anytime you sell something, particularly something that's, you put a lot of effort into, like your work, right? You want to get as high valuation as possible, right? Very often, right, particularly on the larger deals, the sellers themselves, they'll get hire me, somebody like me, right, to conduct what they call sell side due diligence, which is basically the same thing, except I do it for the seller. And I do it with the lens of, okay, let's identify any potential issues that might come up on the buy side due diligence and figure out how we're going to present this to the potential buyers in order um, to explain to them like why this is not necessarily an issue, or to essentially ground the initial diligence in these findings. Right. This is actually something that companies started doing as much as 10 years ago on the larger deals, and it kind of filters itself down into the smaller deals, which I tend to work on. So probably good 10-15% of my work is conducting kind of sell side diligence with a lens of, like I said, helping the seller, you know, kind of put the best foot forward to the potential buyer in terms of the same questions that I would address in a buy side diligence. But I mean, this is where negotiations kind of occur, right? The private equity sponsor looks at the EBITDA, right? They understand what they call multiple, right, on which the companies get traded, that are often very industry specific, and then they get adjusted based on a number of factors, right? Defensibility of the competitive modes, or market issues, or potential personnel issues, whether or not the owner wants to stay in the business or not, right? Whether they receive a you know what stake of the business they retain post acquisition. So all these factors kind of can drive the valuation, right? So it's always it's not like you're buying a car, right? Where you kind of conduct a transaction and then you're done, right? And you just try to like meet the price halfway somewhere, right? You're trying to figure out what it really takes for the seller to be comfortable with this investment into their business, based on kind of where they are and how much they want to get involved in the business post acquisition.
So you can do both. So you can either look from the buyer's lenses and be hired for the from the by the buyer or by the seller, and you would look into what it would need to be, how it should look like, so that it would be better valued or just easier to sell. Is that
Yeah,
right?
yeah. I mean, I think the best way to look at it, right? Eventually, the private equity sponsor will hire somebody like me to do a buy side due diligence, right? So it's always better to conduct the sell side work on the front end in order to surface those issues. You can kind of get ahead of them, before the deal process goes further.
Okay, James, and as a last question for this episode, if I came to you and I would tell you, James, I'm gonna start a business and my plan is to sell it 3 years down the road, what are the things you would advise me to look into so that I can sell as best as I can?
Whew. I mean, that's quite a question, right? Honestly, I would say if anybody is approaching starting a business with that mindset, they're not necessarily going to be successful, right? I think you want to start a business because you see an opportunity to fulfill a niche or provide a service to customers that is needed, right? And if you focus on success and growth and serving your customers well, eventually you can potentially kind of sell it, right? The sectors that are hot, quote unquote, and PE right now may not be the same sectors that are hot 3 years from now. It changes all the time for a variety of logical and illogical reasons. So this is just not a lens that I would apply to anybody looking to start a business, honestly.
I love what you said, logical and illogical reasons. And James, I love it. I love it. And I love the perspective you bring of the right thing is really focusing on your business, what you're going to deliver. So basically, what's your business model? And if you have a good business model, then a couple of months, years, decades down the road, you should have something of value, if I got it right, correct?
Yeah, absolutely. And if you have something of value, there's likely going to be a buyer for it.
That's so good. So, James, thank you so much for this first episode. Such valuable insights. And personally, you got me thinking on some stuff here. And thank you for you watching us here. It's been a pleasure to be with you. And remember, this is a 3 episode series. If you want to keep learning more from James, jump in there. We have the next episode ready. See ya there. Bye bye.
Excellent. Thank you.